Let's kick this off. So, hi everyone. Thanks so much for taking the time to join us today. My name's Georgia. I'm the Senior Customer Success Manager here at Bippit. Really excited for this special Talk Money Week webinar today. It was quite timely that Talk Money Week this year was right after the government's autumn statement. As you will likely have all have seen, there was quite a lot of noise around the autumn statement this year. And it's a great example of one of the times where it can be really beneficial to be able to speak to someone who's a financial expert. So really excited to have Sam and Claire on the call today, who are going to be taking you through the presentation, giving you an overview of what exactly the autumn statement might mean for each of your finances, and hopefully giving you all the opportunity as well to ask any of the pressing questions that you might have. So to introduce, Sam is our head of coaching and also a financial expert himself, a chartered financial advisor, as well as Claire Dunn, a financial coach through Bippit and a financial expert in her own right. Both of them have a wealth of knowledge on this topic and will be on hand today to talk you through the changes, what exactly they will mean for your finances, and also answer any of the questions that you might have towards the end as well. If we're going through and you have any questions, feel free to write them in the chat or in the Q&A, and we'll allocate plenty of time at the end to go through all of them. So please don't hesitate if you have anything that you'd like some extra clarity on. In terms of the structure, we'll start off by giving you that summary of the autumn statement. So what exactly has changed? What will that mean for you? And what can you start to think about based on those changes? Then we'll think about those questions. So we'll open up to the Q&A, any questions that have come through on the chat that you want to ask. We're going to dedicate a good amount of time to that so we can open up that conversation. And then we'll give you some guidance as well on what questions you could be asking your financial coach. As all of you are Bippit users, Bippit customers, you really have that great opportunity to take the questions that you have and get that really personalized, tailored advice and guidance from your specific financial coach through this process. So please do take advantage of that off the back of this call today. And with that, I'll hand you over to Sam to get started.
Great. Thank you, Georgia. And just to reiterate, definitely encourage you all to get your questions into the chats. There'll be plenty of time at the end of the session to run through those. So please do ask, and we'll get to all the questions at the end. But as Georgia mentioned, we've had quite an interesting few weeks. There's been lots of news-breaking headlines. We had the budget just over a week ago now. We had the US election results coming in yesterday, and we got the Bank of England base rate review again today. So it's been quite a week for news. Today's focus is obviously going to be around the autumn statement changes. Importantly, what they were, perhaps what wasn't announced, and how that impacts you. But ultimately, this session is going to be how you can use that news to plan forward and take control of your own personal finances. So I guess to tee things off, I can't quite remember a budget with as much speculation and media frenzy as we've seen with this budget last week. So, of course, it is Labour's first budget in 14 years after, lots of sequential Conservative government budgets. And with that, there was lots of concern and change and I guess propaganda in the media around what could or might not happen. I guess as a starting point, acting on speculation is never typically a good thing to do. Many people, unfortunately, have acted on what they thought might come, and now in a very difficult situation with their finances that they can't necessarily unwind, particularly as it relates to pensions. But what have we seen? I guess that the highlights really from a GDP perspective and just an overall economic perspective is that, Labour are trying to focus on this growth agenda and are banking on growth, particularly in the earlier years of their parliament. And as part of that, they've committed to some spending and some investments into the economy with public sector money. And one of the biggest tax rises you'll all have noted is that tax rise on employer national insurance contributions, which is making up that large yellow spike on the right-hand side of the chart. But what does that mean for households as well? I guess we're going to get onto this in a moment, but one of the bigger things that will impact us all is perhaps something that wasn't announced as such, but is the commitment to freeze the income tax bands until 2028, at which point they'll continue rising with inflation. And what does that mean? It means more and more of us will be paying more and more income tax, also known as stealth taxes, as we get pay rises throughout the coming years. So the tax take in overall terms is going to reach new record highs. We're reaching kind of unprecedented territory as a percentage of national income in terms of overall tax takes, which means it's more important than ever for us each individually to think about our own tax planning and our own financial strategies to ensure we're getting the most from our money as we experience that double squeeze on incomes. So just going to start off the session with some of those highlights in terms of the changes from a personal tax perspective and investment perspective. And I'm going to roll through into pensions, other changes around inheritance tax and so forth. And then we'll open up to some questions on any of those areas or anything you want to ask us relating to your money. So I guess, as I've mentioned, the headline really on the income tax side is that Labour government have committed to freezing the income tax bands, which we'll look at shortly. And that basically means that thousands or hundreds of thousands of people by the end of the term will be paying increasingly more income tax over time. Those rates will unfreeze from 2028 onwards, but of course, we've got lots of budgets to come from Labour in between now and then, and it's potentially likely they could continue the freeze beyond that point. We don't know, but at the moment, they're committing to unfreezing those and maintaining that increase in line with inflation, which means that we'll be, taking more money home in nominal terms each month. So what are those thresholds, just to remind you? So on the income tax side, the personal allowance, which is the first bit of income that we earn at a 0% rate, remains at £12,570. The basic rate band is frozen at £50,270. So anything in between those numbers, you'll be paying a rate of 20% income tax. And then the higher rate band, so over this, you'll be paying additional rate tax, is £125,140. Obviously, before the budget, there was lots of speculation around capital gains tax. Lots of people thought that they might be equalised with income tax rates. That didn't quite come to fruition, although the basic rate band got quite close. But actually what happened was that they froze the capital gains tax allowance at £3,000. So that's the part of any capital gain that you can actually offset against that at a 0% rate. If your gain is in excess of £3,000 per tax year, then you may have to pay capital gains tax at either the new basic rate of 18% or the new higher rate of 24% on anything over that band. And remember, if you do make a capital disposal, which is liable to capital gains tax, you would add that to your gross income for the year, and that's the rate of tax you would pay on those assets. As I mentioned already, really important now more than ever that you're investing money tax efficiently. I'm going to talk about that in the session today, and making sure that you get to keep the money you make rather than give some of that gain to the tax man. There was also some reform to what we call business asset disposal relief for those entrepreneurs or those who have qualifying shares. That lifetime limit of disposals is frozen at £1 million over a lifetime, and the rate of capital gains tax will be increasing over the next few tax years up to the basic rate of 18% on any capital gain. So might not feel like big news because lots of those income tax rates have frozen and stayed the same. But in terms of the impact on your own take-home pay and tax position over the coming years, it really is going to have an impact as we get those kind of pay rises in line with inflation and so forth. And just to put that into context in terms of what we would call, it's called fiscal drag, essentially. So over time, more and more of us are being dragged into paying higher rates of income tax due to them being frozen. Many people call this a stealth tax because it's raising the government significant amount of money, but it's very politically palatable because lots of people don't understand how this works in practice. But just to give some context, so 30 years ago, or just over 30 years ago now, less than 4% of the adult population paid that higher rate of income tax, that 40% rate. And this was introduced as part of the progressive income tax system to bring a bit more equitability ultimately into the tax system and share some of that wealth around the economy from those higher earners. But actually nowadays, that high rate band being frozen isn't just hitting those higher earners necessarily. So a senior nurse, for example, other people in the public sector are increasingly being impacted by paying higher rates of income tax. So much so that the projections by the IFS are that by the end of the parliamentary term, you know, 14%, nearly 15% on the latest forecasts of the UK adult population will be paying higher rates of income tax. So really not the intention of this original policy over 30 years ago. And lots more people, millions more people in the UK will be drawn into paying higher rates of income tax for the first time and really need to take control of their income tax planning as a consequence, rather than just sleepwalking potentially into higher rates of income tax. So we are where we are. We can't control government policy. So there's no point getting anxious about it or spending too much time dwelling on it. What we can do is control our own tax planning and take control to make the most of our own situation where possible. Many people, myself included, unfortunately, we're all in a system where the UK tax system is incredibly complex. And we're piling on policy on top of policy on top of policy, which means we have lots of these quirks in the income tax system, which most people don't understand. But as I mentioned, lots of people, myself included, see this as a missed opportunity for tax simplification. It's not a political point. It's definitely something that both parties should be committing to. But this was a missed opportunity for tax simplification, particularly with the way the income tax system works. So because there's been no changes and the Labour government have just continued with the previous policy on these things, if you find yourself earning between 60 to 80,000 pounds and you have children claiming child benefit, you will be paying an effective rate of tax of 60% or higher between that band due to the child benefit being tapered away as part of what we call the higher income child benefit charge. And for those higher earners, which will impact far less people, but still is a tax quirk nonetheless, if you earn over £100,000 per year, you'll start to lose your personal allowance, which is that first £12,570 taxed at 0% per year, again, given an effective rate of income tax of 60% or more. Why might that be more? Well, in real terms, national insurance is just another income tax. It largely goes into the same pot. And those who have student loans, it's essentially a graduate tax once you're earning over certain thresholds, which is basically another 9% income tax rate on your earnings. So as you can see on the chart, some unfortunate people, if they don't proactively plan their taxes, could unknowingly be paying income tax rates, marginal income tax rates of up to 71%. So again, takeaway is to understand what your gross salary is, understand how that applies to you and your circumstances, especially if you have children you're claiming child benefit for, and speak to your financial coach, A, to understand this in more detail, because it's quite a complex area, and B, more importantly, know what you can do to try and mitigate that higher rate of tax. On the investing side, again, largely frozen, no major changes to tax wrapper allowances. So the ISA allowance for each UK adult remains frozen at £20,000, which is a pretty generous allowance in fairness. So, those people in a household together, married couple, for example, that's £40,000 they could save between them into tax efficient accounts such as ISAs. As part of that £20,000, the lifetime ISA allowance has been frozen at £4,000. We're going to be talking about those later on in this session. The junior ISA allowance for those saving for the young children under the age of 18 has been frozen at £9,000. And as part of that pro-growth agenda, looking at the startup economy, Labour have committed to those enterprise investment schemes and venture capital trust investments, giving the favourable tax reliefs on both income tax and on disposal. So they all remain the same. That's been committed to at least for the next year or so. There have been reforms to capital gains tax. We've talked about those, not as punchy as some people might have thought they would be, but as I've said, and I'll say it again, it makes tax efficient investing more important than ever. So if you're investing outside of an ISA or pension, which are your two main tools for tax efficient investing, you really should be considering using these products to boost the tax efficiency of your portfolio. And particularly with cash, one small downside of rising rates for savers is that their savings may actually be liable to tax, depending on their personal savings allowance and the yield they're getting on their cash holdings. So for some people, it's definitely worth considering a cash ISA to ensure those tax savings are protected from the tax man. But overall, tax efficiency has never been more important than ever. So one part of any investing strategy is to choose the right tax wrapper, of course. And I've mentioned that personal pensions, either through your workplace or an ISA, will be the best tax wrappers available to most working people to boost the tax efficiency of their portfolio. And for most people, if we think how generous those allowances are every tax year with discipline and consistency of investing, they're going to be more than enough for most people to build a very, very attractive pot for their future financial freedom. If you do inherit money or sell a business or have a large lump sum, you might not be able to utilize, or you might overutilize or fully fund those tax accounts, pensions and ISAs. So you may want to use a general investment accounts, but where possible, you should be migrating assets across to ISAs and pensions over the coming tax years where you can. Just a quick overview again then, in terms of the tax-efficient ISAs that are available on the market. So previous governments, George Osborne in particular, was very obsessed with ISAs and actually expanded the range of ISAs available. The main ones you want to be aware of, I think, are cash ISAs and stocks and shares ISAs for most people. So cash for those short-term goals and those emergency funds, stocks and shares ISAs for long-term investment growth. So if your time horizon is 5 years plus. And then for some people, particularly those who are looking to buy their first time property, a lifetime ISA can be a good option too. It's worth mentioning it slipped under the radar a little bit and it was mostly announced pre-budget, but the British ISA idea, which was announced by the Tory government just before they lost the election, that idea has been scrapped. So this was an idea that there would be an additional £5,000 ISA allowance for those people investing into the UK economy or UK listed companies. That idea has now been scrapped, so it's not on the table anymore. Quick summary as to why you would invest in the first place. So why is investing important? Well, it's your number one tool in most cases to ensure that you're retaining the purchasing power of your investments. So that ability to beat inflation over time, particularly important over the last few years, where we've seen cumulative inflation of over 20%. And whilst prices are slowing, so inflation rates slowing, prices aren't coming down, they're just growing less quickly. So investing remains as important than ever. It's the best way to grow your wealth with a globally diversified portfolio. So definitely something you should be considering as part of your financial planning. And just to illustrate, I guess, the power of compound interest relative to saving that money. So investing over the long term is going to grow your wealth far more effectively and more quickly, but it doesn't come without challenges with short-term volatility and so forth. But if we look at just an illustration, it's just for illustrative purposes. It's not guaranteed returns. Returns will vary, of course. But if we took £10,000 and we invested it or saved it at a rate of 2.5% in this instance, looked out the window for 30 years, our balance would be worth just over £21,000. So the balance would just about double at that average cash savings rate. You can get better cash rates than that on the market at the moment, absolutely. But lots of accounts are still paying very, very poor rates, particularly with the large high street banks. So again, definitely review those. But if you were to invest that money at a compounded growth rate of 8% a year, which has been achievable in the global stock markets for a long, long time, And again, same £10,000, same 30-year time horizon, not a single contribution more, just looking out the window for that time. The money would more than 10x to £109,000. So you can see, particularly when you're thinking about your long-term planning, investing is going to help you boost your wealth far more effectively, as long as you're investing on solid financial foundations. And Claire, I'm going to pass to you now to talk about pensions and some other those tax changes in the autumn statement. Over to you.
Okay, thanks, Sam. So yeah, on to pensions changes. And I think it's really fair to say that the changes announced here weren't nearly as significant as the majority of people feared. Certainly, as Sam said, the media went into a frenzy and particularly around pensions. So there were rumours of all sorts of changes to tax relief levels and tax-free cash entitlements. But in the end, it was announced that there are no changes to, first of all, pension contribution tax reliefs. So broadly speaking, they depend on your income tax band, and they're therefore 20%, 40% and 45%, depending on whether you're a basic, higher or additional rate taxpayer. There are, of course, some caveats around this, particularly for additional rate taxpayers. So do chat to your Bippit coach if you want to understand more about tax relief on your pension contributions, but essentially there were no changes there. The pensions annual allowance also remains unchanged. So that's the amount that you can contribute each year while still benefiting from tax relief. That stands at £60,000 or your maximum earnings, so whichever is lower. Again, if that's something you want to understand more about, just chat to your Bippit coach. Tax-free cash entitlements there when you start drawing benefits from your pension. So the portion of your pot that you can withdraw tax-free. And these limits remained the same, despite no end of rumours before the autumn statement. Certainly read stories of people accessing tax-free cash, which, as Sam said, you can't U-turn on. So typically this is 25% of your pension. And the lifetime allowance, which was a limit on the total value of pension savings that an individual could have before incurring a tax charge. This was removed by the previous government and remains removed again, despite various rumours. However, there was one significant change here for some people, and that is that pensions will now form part of an estate. So defined contribution pensions will now form part of an estate for inheritance tax purposes, and this will come in from April 2027. Under the current rules, assets held within defined contribution pension schemes are outside of inheritance tax rules. So more estates going forward will be liable for inheritance tax following this change. And, estate planning will, I'm sure, be a big focus for many going forward. There's a consultation out on this. There's a lot of the granular detail not known about this at the moment, but the detail will become clear between now and prior to April 2027 when this comes in. Next slide, please. So the key message around pensions is really to engage with your own pension. It's the biggest financial benefit that your employer offers you. And it's worth thinking through, things like, do you know where any previous pension pots are? Dig out the details, talk to your financial coach about consolidating your pensions and whether that might be right for you. Look at what you're invested in. One of the most common surprises I find, so when I'm talking to coachees, a lot of people express surprise when they realize that actually they've got a choice of funds that they can be invested in within their pension. So check, what are you invested in? Is it appropriate for you? Review your contribution rate. So are you maximizing your employer contribution? Could you contribute maybe a bit more and then get more from your employer contribution? Your future self will definitely thank you for doing that. Have you completed your death nomination or expression of wish form? This sets out the names of the people who will receive the benefits of your pension if you were to die. Now, nobody wants to think about these things. I appreciate that, but it can be reassuring just to know that your loved ones have been named. It's admin that, can make a significant difference should the worst happen. Also, look at illustrations of projected future income from your pension. Will it be enough? How long have you got until retirement? These are important questions to ask, whatever your age, whatever your situation. But really do engage with your pension. It's a great benefit to have. Sometimes we can look at other jobs perhaps, and you think, well, that sounds like an attractive salary, but then you dig into the detail and perhaps the pension is not nearly as generous. So really look into the detail of what is in your package and make best use of it would be my advice. Next slide, please. So pensions are incredibly powerful. They are your long-term savings account. They can hold all sorts of investments, investments that hopefully can align with your objectives and your beliefs if you spend the time looking at the choices. They're very cost effective. Charges are capped, and with workplace pensions, you often benefit from discounted charges. They're tax efficient due to the tax relief that you receive on top of your contributions. If you're somebody that wants to access savings generally, then a key benefit of a pension is that you can't access it until later in life. So it's safely locked away, no temptation. And last but not least, the growth within your pension fund is tax-free, so you won't be taxed on the gains made within the pension. Next slide, please. One question that's often raised is whether to pay into a pension or a lifetime ISA. So it's just a question that's quite commonly asked. The answer to this, like many questions related to personal finance, is it depends. So I'm just going to compare the features and benefits of the two types of products so that you can get an overview of those two lots of features. So firstly, I mentioned earlier the tax relief available on your pension contributions, which is dependent on your income tax band. So with a lifetime ISA, you can potentially receive a bonus of 25% of your contribution, though this is capped at £1,000 maximum per tax year. All investment growth in the two products is tax-free. When withdrawing from a pension, 25% generally is tax-free. The rest is taxable as income, but with a lifetime ISA, you can withdraw tax-free in the same way that you can with other ISAs. Though there are some criteria around lifetime ISAs that I'm going to come on to. With a pension, you can currently access it from age 55 onwards, but that's changing to 57 in 2028. With a lifetime ISA, you can access it from age 60, unless you're buying your first home with a value of up to £450,000 or you're terminally ill. So that 450,000 limit was something, again, there were rumours that might change with the autumn statement, but there's no change to that. How much can you contribute? Well, there's a big difference here. So with a pension, you can contribute up to 100% of your gross salary or £60,000, whichever is less. But with a lifetime ISA, you can only contribute £4,000 per tax year. On to age limits. So with pensions, you can contribute into a standard pension from age 18 onwards, and you can actually carry on contributing and receiving tax relief all the way through to when you're 75, although contribution limits do reduce once you start drawing income from your pension. With a lifetime ISA, you can only open one between the ages of 18 and 40, and you can only contribute up to the age of 50. Both products have got a wide range of different investment funds available to you. And technically speaking, there's actually no upper limit to what you can hold in each product. As with all financial products, the devil is in the detail. So do raise this topic with your Bippit coach. If you are perhaps considering a lifetime ISA, want to chat through some of the finer detail, then do raise this. Just make sure that the product is right for you. So now just moving on, looking at some other announcements in the autumn statement. Next slide, and I think next.
Sorry, Claire, just whilst we're frozen on that slide, just to add, because it is a question that comes up quite frequently, really, and I think For most people, pensions are going to be one of the best accounts to be using, particularly through the workplace. If you have a pension matching scheme or a salary sacrifice scheme, there can be lots of big benefits to saving your pension on top of the ones mentioned in the previous slides and this one. But particularly for basic rate taxpayers, lifetime ISAs can be a really good supplement to long-term saving because of the 25% bonus versus the 20% tax relief you get on a pension. It's not to say you should do that instead of, but if you're thinking about additional funding and tax wrapper diversification, lifetime ISAs can really complement your suite of products with the same accessibility to certain funds and manage your own investment strategy. But of course, there are certain restrictions. So particularly useful for those who are basic rate taxpayers to consider. But pensions remain a really, really good product for everybody ultimately. Sorry, Claire, back to you.
No problem. And next slide, yeah, thank you. So other changes, or not, as the case may be. The threshold for inheritance tax, which is the tax that is paid on your estate upon death, if it's over a certain value, that's to remain frozen until 2030, meaning that more and more estates will be taxable over the next few years. And the rate of 40% over certain thresholds remains the same as well. Now, everybody has what's known as the nil rate band, which is £325,000. Additionally, if somebody's estate includes their home and their home is inherited by their direct descendants, then the estate would also be entitled to an additional £175,000 residence nil rate band. The inheritance tax rate on any amount over this is broadly speaking 40%, and I say broadly speaking, there's always a few little quirks and exceptions, as with most financial matters. So again, if it's something that you need to start digging into more detail behind this, then your Bippit coach can help you in looking at this in more detail. And it's important to consider your inheritance tax exposure should the worst happen. Particularly if you're cohabiting, I'd say, and not married, it's worth working through the financial impact of inheritance tax on your partner, as your allowances can't be passed to your partner in the same way that they can be between married or civil partnered couples. So that's just something to be aware of. And a couple of other changes to note. The changes to inheritance tax rules will also extend to agricultural property and business property relief. So this includes qualifying business assets, but there are also a wide range of investment products designed to fall under BPR rules that are available as well. So it's important to know that that applies to them as well. Previously, these assets received 100% relief from inheritance tax, with new rules now providing a tax-free threshold of £1 million, with any amount above that being liable for inheritance tax with a 50% relief. And as I talked about before, unused pension funds and death benefits will be included as part of an individual's estate for inheritance tax purposes from April 2027, but there will be more detail on that published in due course. Next slide, please.
Great. Just to add as well, Claire, I think it's quite important to mention, because inheritance tax, I think it's fair to say, is probably the most unpopular tax in terms of perception of taxes. But at the moment, only 4%, roughly 4% of estates will pay inheritance tax, which means the vast majority of working people will never pay inheritance tax. And under the current frozen tax allowances, as Claire's mentioned, a married couple could have up to £1 million of tax-free allowances, which will cover most people, and then be able to pass that tax-free to their beneficiaries. So it's not something that most people have to consider, but certainly those with large pensions now should be starting to proactively plan for. So it's definitely something to keep tabs on, but lots of people won't need to worry about inheritance tax in many ways.
So on to property. There are a number of changes around property, as has tended to be the case recently, with thresholds moving around quite a lot in recent years on stamp duty. And overall stamp duty land tax will increase. So stamp duty, it's a tax due if you buy a property or land over a certain price in England and Northern Ireland. The amount you pay depends on the cost of the property, whether you're going to live in it or whether you own any other property. For those purchasing property in addition to their main residence, so perhaps a second home, buy-to-let property, the level of surcharge has increased from 3% to 5%. And note that that is a surcharge, so that's on top of the standard stamp duty charge that you would have to pay. And this came in straight away, so there was no time to avoid the rate hike. So for anyone that was right in the middle of the process there, they would have been whacked with an additional charge that they certainly wouldn't have been expecting, I suspect. The stamp duty threshold for first-time buyers is currently £425,000, but that will be £300,000 from April 2025. So there's some discussion in the press at the moment over whether more first-time buyers will make purchases, particularly over the coming months, to take advantage of the window. For non-first-time buyers, there's a reduction of the threshold, so that's currently £250,000, reducing to £125,000. Next slide, please. And there's a few other changes which may or may not be relevant to you. First of all, if you have children, so child benefit increased from £25.60 to £26.05 for an eldest child, and from £16.95 to £17.25 for any subsequent children. There was no announcement to an increase in the rate of carers allowance, which is currently up to £81.90 a week. However, the Chancellor did increase the weekly earnings threshold at which it is removed. So this will rise from £151 per week to the equivalent of 16 hours of the national living wage, or £195.36, and that's from April 25. The minimum wage is to rise from £11.44 to £12.21 per hour. We've talked through surcharge on second properties. VAT on private school fees, that will be coming in from January 25. So this one obviously has a big impact on anybody currently educating or planning to educate their children in a private school setting. Sam talked about the high income child benefit charge remaining unchanged. I know there was a lot of lobbying and pressure around changing this, but nothing was in fact announced around this in the autumn statement. So that's the tax charge designed to claw back child benefit, basically, where you or your partner have an adjusted net income of over £60,000. Stamp duty, land tax thresholds have reduced, as I've just talked about. So more people will be paying tax on property transactions than have been. If you're a driver of a non-electric vehicle, then some good news was that fuel duty is set to stay at its current level, and the existing 5p per litre cut will stay in place for another year. And then finally, as Sam said, the junior ISA limit of £9,000 is frozen until April 2030, as is the rest of the ISA limits, in fact. So the £20,000 ISA contribution limit, which is generous, that remains £20,000. So hopefully those updates have given you some food for thought about your own circumstances. You may have a number of questions already that hopefully you've put into the chat. I'm going to pass you back over to Georgia to focus a bit more on questions.
Thank you so much, Claire and Sam. That was really insightful, and I know we've had some great questions coming through the chat already. Just wanted to pause here for a moment to say that all of you are here today ultimately because your employer has given you access to Bippit. So we can't emphasize enough how valuable it can be to speak to your financial coach. Some of you may have used the service already. Some of you may be on this call to understand a little bit more about Bippit and how your financial coach can help with these particular situations. But if you have any queries either about these changes that have come out of the autumn statement or about your finances generally, Now, as we're coming towards the end of the year, it's a great time to book in those calls. You can either access us via the mobile app, so we're on both iOS and Android, or if you prefer to use the web version at app.bippit.com, I'll put the question in the chat as well. But just remember that you have unlimited calls, unlimited messaging with your coach. They'll be able to get to know your specific situation. So some of the questions that we'll have on today, Claire and Sam will be able to give you a kind of intro answer or an overview answer. But if you have follow-up questions, absolutely book in that call with that coach who'll be able to tailor their guidance around your specific situation as well. So with that, we'll open up to the questions. I know we've had quite a few come through. I'll just start with this one in the chat first. So with the accessibility of the pensions versus lifetime ISAs slide, so the one that was comparing the two, they saw that you can only withdraw the funds from age 60, so that was around the LISA. Is this the case with other ISAs, or is there no associated age restriction there? Whoever wants to take that, I'll hand over to the two of you.
Have to take this one. Yeah, so in simple terms, no. The only ISA that has an age restriction on withdrawal is the lifetime ISA. So the lifetime ISA is kind of dual purpose in many ways. It's for first-time buyers, so used towards a first-time property purchase. But if you've already purchased a house or already a homeowner, you can also use the lifetime ISA as a kind of quasi-retirement product. And because it is a long-term savings product for that purpose, that's why there's that kind of age restriction on it. But your cash ISA, your stocks and shares ISAs, your other ISAs have no age restriction on them and no tax restriction on withdrawals either. So you can withdraw as much or as little as you want, either as a lump sum or as an income from your other ISAs, which make them a great tool for your short or long-term savings. But all I would say is cash ISAs tend to be more for short-term savings or emergency funds and things. Whereas where you're investing for the longer term, sort of 5 years plus, that's where you'd use something like a stocks and shares ISA. In a cash ISA, you can't hold other asset classes. It tends to be restricted just to cash. Whereas in a stocks and shares ISA, and a lifetime ISA, and a junior ISA, you can hold a wider range of asset classes, including stocks and shares, equities, bonds, commodities, and other asset classes as well.
Thank you, Sam. So another question we have here. So has there been any change to the 60% effective tax between 100K and 125K?
Claire, do you want to take that one?
Has there been any change? No, there hasn't. So, we know. Sorry, Sam, do you want to?
No, I was just saying, yeah, you're absolutely right. There's been no change as we looked at the slide at the start in terms of those tax nuances. There's still, unfortunately, that kind of personal allowance taper for those earning between 100 and 125,000 pounds, which basically means for every £2 over 100,000 that you earn, you lose 1% of your personal allowance. And it tapers away evenly. And so when you get to 125,000 pounds, you have no personal allowance, essentially. Claire, is anything to add to that?
No, it's something to be really mindful of, I think, and really do the calculations. I've come across many, a person in the past who has been quite horrified when they realise actually how much they're being taxed. So yeah, it's something to be really mindful of.
Yeah, lots of people don't realise this because it's kind of an effective rate of tax in many ways because you're losing your personal allowance. But one thing I would just encourage you all to think about is managing your household your finances as a household. So if you're in a relationship with somebody, particularly if you're married, there's lots of reliefs and allowances available to you to share with one another almost. So 2 lots of capital gains tax allowances, for example. But also it's unfortunate, but the reality of the income tax system is that you're better off in net terms after income tax to have a household with 2 people earning £50,000 than 1 person earning £100,000. So it's worth thinking about if you're sharing childcare responsibilities or you're both kind of good earners, to think about how you kind of manage your household finances to get the best net income, but also give yourself as much family time together as possible ultimately. So just one to think about.
Absolutely. Something to add to that as well for anyone who listened to what Sam just said and was considering that with your conversations that you have with your Bippit coach, many of our users do bring along their partner or spouse to the call, especially if you manage your household finances together, if you want to ensure that the protection you have in place is all set up and that there aren't any gaps. Absolutely, that's something that we'd encourage you to do. So sit down next to your partner while you have that coach call, and you can look together at the full picture, and ultimately they can benefit from speaking to the Bippit coach as well. So another question here is a good one. Maybe I'll direct this one to you, Claire. So can you mitigate the higher rate of tax, so i.e. 60K to 80K, in losing child benefit through salary sacrifice?
Yes, I mean, a good way is to get money into your pension, and hopefully we've illustrated as we went through, just how valuable that pension benefit is and how useful it can be. So yes, do use your pension allowance, because it will in effect come off your gross salary level. So it will appear that you are earning less, but of course that is all being invested for your retirement.
Yeah, just to add as well, I don't like the word sacrifice because it sounds quite negative. I prefer to use salary exchange almost as a phrase, it's the same thing. But child benefits assessed on the higher earner in the household. It's a really important point. So if you're both earning, assessed on the higher earner. And salary exchange is the best tool you have available to reinstate that child benefit, either partially or fully. And as Claire mentioned, pensions is the best salary exchange tool you have available. But some workplaces will have other schemes available. Might be childcare vouchers, it might be electric car scheme or cycle to work scheme. There's lots of schemes available, but pensions will be your silver bullet because you're saving for your long-term future. So you're getting a big upgrade there, but also reinstating that child benefit. So yeah, just that extra nuance there. It's the highest earner in the household who that's assessed on.
Definitely, I agree completely with the term sacrifice. Before I joined Bippit, I thought that meant ultimately that you were losing out, and it wasn't until I learned a bit more about that, what the benefit was, and now I increase my salary sacrifice so I can speak to that from a personal level. An additional question here. So this is a nice broad one. So what would you recommend as someone starting off investing? What would be the first steps?
Well, I'm happy to take that. So I think first of all, just go back to the basics, ensure that you have the basics in place with your finances. So have you got an emergency fund? Have you paid off high rate debt, for example? So make sure that they're in place. In terms of starting investing, think carefully about your goals. So what's the time frame of the goal? So for investing, you would be looking at least 5 years, but the longer you have, the better. Then obviously look at affordability. So what can you afford to invest, knowing that money, you want to leave that for a long period of time. So you don't want to be trying to access that. In terms of approaches to investing, I think that's something raised with your Bippit coach, and they can talk through the process of investing, understand so that you can understand terminology around it. There's a lot of potentially confusing terminology. It's not nearly as complicated as it appears to be. Have a chat about it. It's a great topic to raise, in fact, with your Bippit coach, so that you can make sure that investing is right for you, done appropriately for you, that you feel comfortable and confident as well investing. I think that's where I'd start. I'd almost start with what's your current situation, make sure that's all in place before you then embark on it.
Yeah, just add very briefly, and Claire's absolutely spot on with all of that. There's a bit of a misconception when people say starting off investing. The pension landscape's changed significantly over the last couple of decades in that most people, certainly in the private sector, will have defined contribution pension schemes, which basically means they are an investor already. They're investing money through their personal pension scheme. They're taking a certain level of risk in that. They just don't quite realize it. It's not managing it proactively. So obviously when people say start investing, they typically mean outside of a pension, but it's definitely a reminder for lots of us to review our pension investment strategy, make sure it's suitable for us. We'll be in a default fund, which is, might be suitable for many people, but it won't be suitable for everybody. So it's worth reviewing. But yeah, that's a good place to start.
Thank you both. Have another interesting one here. So if you have exhausted your ISA allowance, Is it best to put your money into a normal tax savings account or a general investment account?
Yeah, I can pick this one up. So it really depends on your personal circumstances and ultimately what your financial goals are. So it's really important to define that first and foremost, because if you need to build up your financial resilience and that short-term savings pot, so that emergency fund or rainy day fund, a cash pot is going to be much more suitable. So savings accounts will be much more suitable. If you're investing for long-term growth and you're looking at medium to longer term goals, whether that be financial freedom, purchasing a car or anything like that 5 years on, or more than 5 years on, a general investment account could serve you better, assume you've already utilized those ISA allowances as inferred in the question. But for lots of people, as Claire's mentioned in the presentation, the pension allowance is very, very high in terms of the annual allowance. You've got the £20,000 ISA allowance on top of that. So for most people, general investment accounts won't be necessary, but they're a great tool with a wide range of investment options for those who are looking outside of those options to grow their money in the investment markets. But it just always depends on what you're trying to achieve. So short term, low risk, low volatility would be sort of cash savings. And you can get pretty good rates. You can get different types of cash savings. There's instant access. You can get fixed term deposit accounts, and you can get up to 5% on cash, risk free in many ways. But still, longer term, you can still get a higher return, not without short term volatility, but a higher return over the long term in an investment account. So it depends. Again, speak to a financial coach about what the right balance is for you. How much should you have in your emergency fund? How much should you be investing for your own longer term goals?
Thank you, Sam. I know we've still got a good amount of questions coming through, so we're going to try and get through as many as possible in the remaining time that we have. And then any that we don't get to for any reason, just really encourage you to send those to your Bippit coach. So this one here, Sam, you mentioned that capital gains is factored into income. Does this mean in simple terms it's double taxed?
I guess I'll take that one. Sorry, Claire, we're alternating, but that one was name checked, so I'll take that one. So I guess you could argue there's a kind of a philosophical argument, tax argument, that yes, you're being double taxed because you're potentially investing money from already taxed income. And then if you get a gain on that income, which is in excess of your capital gains tax allowance, that would potentially be taxed as well. So I guess you could argue it is a double tax. But yeah, the way the tax system works on capital gains is you're only taxed on the gain element. So if we use a very, very quick example, say I invested £10,000 in an unwrapped account, so not in an ISA, in a general investment account, I invested £10,000 in the stock market. That goes up to say £30,000 over a series of 5-10 years. I have a gain of £20,000. So it's that £20,000 which would be liable to capital gains tax. But I've got my capital gains tax allowance, so I can use that each tax year. It doesn't carry forward, so it's a fixed amount in each tax year, which means that £20,000 now becomes £17,000. And for capital gains tax assessment purposes, that £17,000 is then added to what my income level is, just to determine the tax band. So say, for example, I was earning £50,000 a year, well, let's say 50,270 to be precise. All of that gain would fall into the higher rate of capital gains tax. So I pay 24% on the gain net of that capital gains tax allowance. So it's quite complex. Speak to your coach about how you calculate that. But for most people, as you've seen there, you need to start getting things in tax efficient accounts where possible to avoid what might be deemed as double taxation. I hope that helps. But if you've got a question, definitely follow up your coach about the specifics on that in terms of numbers and run those calculations together.
Thank you, Sam. We'll do some question tennis, and I'll pass this one on to you, Claire. So, what can you do with the stocks and shares LISA if you're now buying a house over the LISA house price limit? This person, it sounds like they're buying a house with their partner, so they can now afford a more expensive property. Do they have to leave their LISA pot now until they're 60?
Good question. So now I believe, and Sam, do jump in on this one, because lifetime ISAs, I know the rules have changed around the penalty, which I believe was 25%. So if you're withdrawing that money from the lifetime ISA, the penalty was 25%. So the government's trying to get back that bonus that they've applied to the lifetime ISA, but that's changed to 20%. So there is a penalty of withdrawing that money if you're not going to comply within the rules that were set out on the product.
Yeah, there was, as Claire said, it's being reviewed because there was a nuance that if you were withdrawing money from a lifetime ISA, you'd be taxed 25 or, penalized 25% on the overall balance, which basically means that you could actually have less than you put in yourself. So definitely check your product specifically to see what that looks like, because if there's a penalty, ultimately, which was definitely the case before, and you're getting back less than you'd put in, so all the bonus goes, but also the way the maths works, you get slightly less than you put in, you might want to consider it as a long-term savings account. But again, it's worth looking at your product, speaking to your coach, and then making a more personalized decision on that one based on the numbers.
Thank you both. Great question here. We talk a lot at Bippit about the importance of starting to get control of your finances young. So I really like this question. It says, for someone who started full-time work from a young age, what would you recommend they do if they wanted to save? And then also, what would be the best thing for them to put savings into? So a couple of different points there. Whoever would like to take it.
Go on, Claire, you go first, and I can jump in as well.
Could you just repeat the question? Sorry, I had a roofer banging in the background. Sorry, Georgia.
No worries, Claire. So this question was, as someone who has started full-time work from a young age, what would you
Yeah.
recommend they do if they wanted to save? And what would be the best thing for them to put savings into?
So if for saving, well, hopefully, first of all, your salary is going to go up over time. So if you're early on in your career, one of the key gems I would say is trying to pretend to yourself as your salary increases that perhaps you haven't had a salary increase, and using that money for savings. So that's one thing around saving and building savings over time. I think being mindful of what you're spending, in spending with intention is one of the key things. So really thinking about it. And if that means writing down your daily spending, even if that's what it takes, then I would encourage you to do that. It's about really engaging with your behaviors around spending and saving, looking at your budget, creating a budget if you don't have one, looking at the 50-30-20 rule. So setting sort of 50% as the limit of your essential spending, 30% being your fun money, 20% being your savings money. Start at that strategic level, and then apply that to your own finances and see if that would work. And keep revisiting it. This is not stuff that you put in stone and leave. Keep engaging with it. And have goals, have objectives that you want to achieve and different timescales, but really taking the time and thinking about these things, it means that you've got a much greater chance of success with achieving your goals.
Yeah, absolutely spot on. I think the key thing here, so as Claire mentioned, lifestyle creep, trying to avoid lifestyle creep, trying to figure out a lifestyle that you're happy with and comfortable with once you're growing your earnings, because any earnings in excess of that could easily be wasted by just upgrading your wardrobe, your gym membership, having a nicer car, going on a few more holidays. If those things genuinely bring you joy and happiness, by all means go for them. From my experience, people just tend to spend what they have coming into their bank account. It doesn't necessarily correlate to more happiness or more fulfillment. So if you do get to a level where you're very comfortable and you're very happy with your lifestyle, think about how you can create future freedom for yourself by saving and investing the difference. And that's the key. In terms of where you do save and invest, that difference will very much depend, as Claire mentioned, on your own goals and objectives. And that's where your own personal financial coach can help you. But George, I'm mindful of time. Do we want to sort of wrap up?
I was going to say, unfortunately, I think we might have to leave that as the last question for today. We've had lots of questions in the chat, so thanks everyone for engaging so much. Anyone whose question we didn't get around to, please do send that message to your Bippit coach. Maybe you're signed up already and you can just open the app and send them a quick message. Or if you want to sign up at app.bippit.com and register with your coach now, please do so. Any questions you have about accessing Bippit itself, if you're not sure how to register, please reach out to support@bippit.com. I put the email address there in the chat. But thanks so much, Sam and Claire, for the presentation today. Thanks everyone for joining. I hope you found it insightful and useful. And any feedback or suggestions, please get in touch.
Great. Thank you, Georgia. And thank you, everybody, for joining.
Thank you.
Thanks, everyone. Have a great day.